All right, today we're going to be financial detectives. We're going to perform a kind of autopsy on a single stock's really rough day. It's the perfect case study, to see how technical analysis works in the real world, especially when the signals get messy. So let's dive in.
So picture this. You see a headline that a stock just tanked nearly 12% in one session. Now, your first gut reaction might be to run for the hills, right? But is this actually a sign of total disaster, or is the data telling us a much more complicated, maybe even more interesting story? That's the puzzle we're going to try and solve. Okay, let's set the scene here. The stock we're looking at is Open, and it's important to know it was already in what analysts would call a downtrend. And then, bam, it got hit with this incredibly sharp one-day sell-off.
And just how sharp are we talking? A drop of 11.69% in one single day. Now that is a huge move that gets everybody's attention, and it's exactly why we're digging in to see what the charts are really telling us. Now, what gives this drop some serious weight is the volume. We're talking over 101 million shares traded hands. You can think of volume as like the emotional intensity of the market. A price drop on low volume is kind of like a whisper, but a drop on massive volume like this, that's a shout. It tells us there was real force, real conviction behind all that selling. So the first step in our little investigation here is to look at all the evidence that supports this big negative move. Let's put on our skeptical hats and just examine the case for caution, which, I gotta say, at first glance, looks pretty overwhelming. The short-term problem just jumps right out at you when you look at the moving averages. The current price of 6.12 has crashed below all the key ones, the 5, the 10, the 20, and the 50-day. If you think of these averages as the consensus price over different periods, while the stock is now trading below every single recent consensus, the mood is definitely sour. But, and this is a big but, it's not all bad news. If we zoom way out, the price is still well above its 200-day average, which is way down there at 407. This is a really crucial distinction. It means that while the recent trend is, frankly, ugly, the very long-term uptrend is technically still alive. So this looks more like a deep, painful correction, not a complete collapse, at least not yet. Now, this recent price action also created something called a death cross. Yeah, it sounds super dramatic, and that's kind of the point. This happens when a shorter-term average, like the 20-day, falls below a longer-term one, like the 50-day. It's just a classic signal that analysts see as a sign that all that negative momentum is really picking up steam. Okay, so the picture looks pretty bleak, right? But this is where technical analysis gets so fascinating, because if you look a little bit closer, hidden in that same exact data, you can actually find some glimmers of hope, some bullish signs that are suggesting a reversal might be brewing under the surface. And this is where the plot thickens. Let's look at an indicator called the MACD. On the one hand, the main MACD line is below its signal line. That's a classic bearish sign. But, and you gotta see this, the MACD histogram is actually positive and it's rising. This suggests that the downward momentum is losing steam and fast. It's like a car that's still rolling downhill, but you can hear the engine sputtering like the driver just took their foot off the gas. And the MACD isn't alone here. Other indicators are sending these mixed signals too. The stochastic indicator, it's showing a bullish crossover. The ADOS oscillator, which is a tool that tries to track where the smart money is flowing, is positive. That's a hint that some buyers might be quietly stepping in. And finally, the risk-reward ratio is over 3, which basically tells traders that, from this price, the potential reward for being right might be more than 3 times the risk of being wrong. So, what in the world does all this conflicting data mean? Well, it means the stock is at a crossroads. It's at a fork in the road. The evidence is basically leading us to two very different, very distinct possible futures. You have the bullish case and you have the bearish case. Let's map them both out. Okay, for the bulls to really take control, a very specific sequence has to play out. First, the price has to find a floor, what traders call support, somewhere in that 580 to 600 zone. Then it has to bounce, and it has to reclaim the key level of 635. If it can clear that hurdle, well, that could ignite a move higher, maybe targeting 668 or even that 50-day average up around 706. But on the flip side, here's the bearish scenario. The stock fails to find support in that critical 5.79 to 6.00 zone, and that failure would be a major sign of weakness, and it would almost certainly trigger a whole new wave of selling. From there, the next logical target for the sellers would be the next major support level, all the way down at 554. So you've got these two competing stories, right? How do we know which one is winning?
Well, we watch the decisive levels. These are the key numbers, the battle lines that analysts are totally focused on right now to see which way this tide is turning.
The first and maybe most important number right now is 5.79. You can think of this as the line in the sand. If the price breaks decisively below this level, that is a major victory for the bears, and it signals a lot more trouble ahead.
And for the bulls, the number they have to conquer is 6.35. This is their immediate hurdle. It's the pivot point. Getting back above this price would be the very first sign that the buyers are starting to wrestle back control.
So really, the whole thing boils down to this. It's a battle between these two levels, 5.79 on the downside, 6.35 on the upside. The outcome of that fight is going to tell us everything. It'll show us whether the sellers are still in charge or if the buyers are actually mounting a comeback. And all this leaves us with a really fascinating final question, doesn't it? Technical analysis gives us the map, right? It shows us the key battlegrounds. But when the data itself is pointing in two totally different directions, what ultimately guides a trader's final decision? Is it just pure discipline? Is it gut intuition or something else entirely? Definitely something to think about.